In this session, I'm going to talk about how the capital planning is done at large bank holding companies, right? And a few important aspects regarding what the supervisors typically expect, what the banks should really follow with respect to capital planning, and what are the current practices that are followed at a good versus moderate versus weak kind of companies. Now, what is this all about? Right? What is this prospect of bank holding companies? And what are these practices talking about? All the US banks which are in the top tier and which are having a consolidated assets of more than 50 billion, they have to the regulation says that they have to maintain a capital plan and it has to be assessed for their capital adequacy. So they have to have a well supported, well documented kind of a capital plan and a kind of a process which really assesses their capital adequacy. So they have to take into consideration the various aspects of risk management. So they have to, on a regular continuous basis, they have to evaluate their risk identification processes, their risk measurement processes, risk management practices. They have to evaluate on regular basis, and all these practices should be linked with the capital planning process, the kind of the stress test that they have to create, scenarios that they have to create, the stressed scenarios that they have to create, right, to assess what is the kind of loss that the bank can incur under the stressed scenarios. So the losses that are generated during the stressed conditions, there should be a proper assessment mechanism for that, and at regular intervals of time they need to have proper processes which will estimate the revenues and the other aspects regarding governance, the corporate governance practices, the kind of internal and external controls that the bank has put in place to make sure that the risk mitigation and management is done appropriately and the capital planning is done in line with the risk that is foreseen as a part of the estimation processes. And every bank holding company which falls into this kind of a category, the large, which falls into this category, they have to develop a stressed scenario, right? Every BHC, based on its business objectives, based on its goals, it has to develop a stressed scenario or more than one, which is in line with the business model and the portfolios, and that stressed scenario need to be tested, assessed for the losses, revenues. So that is part of capital planning that we are talking of. Now, when we talk about an effective capital adequacy process, there are 7 important principles that drive this capital adequacy process. First of all, the foundations of the risk management needs to be sound. What does that mean? The infrastructure that the bank has for risk management, it should be good enough. It should take care of proper identification of the risk. There should be mechanisms for measurement of the risk, where the probability is, the severity is, the total exposure, all those are measured with comfort. Proper prioritization of the risk happens. The assessment and prioritization and the control Control is more talking in terms of mitigation management of all the risks that are arising from different kinds of business activities that are taken up by the bank. So if it is having, then the principle number one, the sound foundational risk management is in place with that particular bank holding company. Then the next important thing that we are expecting as a part of effective capital adequacy process is the loss estimation methodologies need to be effective. So whatever the measurement that we have done during the risk measurement process, those measures, they have to be converted. There should be a strong or an effective mechanism which can translate the risk measures into an estimate of potential loss over different kinds of scenarios, both normal scenario, what could be the potential loss, and the extreme scenario, which is the stressed scenario, what could be the expected loss, right? And different kinds of environments, the probabilities of occurrence of those kind of environments. And finally, all those losses need to be aggregated across the entire enterprise. So if this process is there for a particular bank, then principle number two is very effectively implemented at that particular bank. Then the third important aspect is the estimation of the resources. The methodologies that are existing for the estimation of the resources need to be solid. So what are the different available capital resources? So the bank should have a clarity. What are the available capital resources? How do I estimate different kinds of available capital resources? Again, over a normal scenario as well as a stressful scenario. And also I should have a mechanism under different kinds of environments. What should be the kind of capital do I require? Under normal environment, what should be the kind of capital? Under a stressed environment, what should be the capital? So I should have a proper mechanism in place to estimate the capital resource that is required. Then the bank should really have an assessment of sufficient capital adequacy impact. Now that it has loss estimation methodologies, capital resources estimation methodologies, these two need to be integrated, which means point number 2 and point number 3. Now that it has good capacities or good capability to estimate the principle number 2 and principle number 3, now we are talking of bringing those two things together and finally identifying what is the kind of impact on the capital adequacy of the bank, and is it really in line with the goals of the company, right? So that kind of an assessment should be done. What is the kind of impact it has on capital adequacy? Then another important aspect of effective capital adequacy process is there should be a comprehensive capital policy, organization level, enterprise level capital policy, and capital planning that needs to be done. So here all the practices relating to the capital planning, they should look at, okay, capital goals. How much is the capital required? What are the different levels of capital under different scenarios? What is the breakup of the capital across the different sources of capital? What should be the breakup of the capital? And what are the different actions that are required with respect to the capital and the different contingency plans regarding the capital? So everything should be in place with respect to the capital planning and policy. Capital planning will take up what are the aspects of capital planning slightly later in this session. But This is one more aspect which the bank should really have if I have to say that its capital adequacy process is very effective. Then comes the very important aspect, the internal controls. Right? How much is it able to monitor the capital adequacy process? What are the tools and techniques the bank is having for monitoring the capital adequacy process? What are the kinds of policies that it has set with respect to ensuring that the capital adequacy exists? What is the kind of change control procedure that is there? How is the model validated? Different kinds of models that are created. What is the validation process for the same? Right? What is the process for reviewing the models? Independent reviews. What is the documentation procedure? And how frequently the audit is conducted? And what are the various aspects of the audit that are conducted? So if a bank is following all these things, having strong internal controls, then its capital adequacy process is very, very effective. And on the top of all these things, effective governance. Probably without this, any of the others become just redundant. So the board should play an active role in ensuring that all the above steps are done with perfection. Senior management should have a real control. The entire capital adequacy process should be effectively monitored by the board as well as the senior members. They should come out with regular reviews of the sufficiency of the infrastructure, right? They should follow the they should ensure that step number 2, loss estimation is done effectively. Step number 3, resource estimation is done effectively and using the best procedures, and based on that their capital goals are evaluated and assessed at regular intervals of time. They have created adequate stress scenarios so that they can measure the losses in the worst case situations as well. Any kind of limitations with the current model, current processes, the board should take the initiative in terms of assessing them and probably suggesting the modifications to them. And finally, all the capital decisions need to be approved by the board and the senior management. The more they involve themselves, the more they govern the entire process, the more is the effectiveness of the capital adequacy ensured within any bank and large holding company. Now we go step by step. One, first thing with respect to risk identification. What are the key practices that needs to be followed? Few things which are very common to understand. We have to ensure, or the bank has to ensure, that all the risks are appropriately accounting for. Right? It has identified all the kinds of risks. The market risk, the credit risk, the operations risk, the liquidity risk, the reputation risk. You can very well classify different kinds of risks, and you have to ensure that all the risks are appropriately accounted for. First step. So we are not missing out on any of the risks. And identify the potential exposures that are coming out from all these risks. So when I am saying all these risks, I am looking both at on balance sheet positions as well as off balance sheet position. So because of each of these risks, what is the total potential exposure amount that is at risk? So evaluate that aspect and set a process which can be repeatable, which is more systematic, so that all the risks can be identified at regular intervals of time, and at the same time for every risk I can very well assess the frequency of occurrence as well as the potential severity and how much it will typically impact the capital. At regular intervals of time, this monitoring should happen and this assessment should be done. So there should be a proper process in place. And any kind of assumption that we are making, especially with respect to the risk reduction mechanisms, are there any kind of netting arrangements? Are there any kind of collateral arrangements? So any of these risk reduction, risk mitigation mechanisms, any kind of assumptions that are there, right, or risk transfer, some kind of insurance or alternative risk transfer mechanisms if they are there. So all those assumptions also need to be documented as a part of the risk identification practice. Of course, many of the big banks and holding companies, they have a decent inventory of all the risks that to which they are exposed to. They maintain a big repository. They keep updating it. So any new risk comes up, it goes into their inventory. So generally many large bank and holding companies, they are very much competent in terms of identifying different kinds of risks. Now, the most important aspect is almost from all the lines of business: corporate risk management, finance, treasury. So different kinds of business lines, both the line as well as the support functions, they have to provide input. So which means cooperation is required from all the departments to come out with a comprehensive and an effective risk identification practice. Right? So all the departments should really provide input to the process. And every risk measure that is getting designed, it should be able to capture the changes in the risk profile of the institution. So any risk profile, the risk appetite of the company changing. So that change has to be captured as a part of all the risk measures. So that should be directly linked with the assessment of the capital adequacy of the bank. And finally, all these bank holding companies, they should be able to demonstrate whatever the risks that they have identified, how are they mapped to the capital planning process. Each of the risk, right, including isolated as well as the correlation between them. So how each of the risks that they have identified, how is it being mapped to the capital planning process? So a simple way to look at, let's say a quantification methodology is being adopted by a BHC. So let's say this is a closed form formula and it's not a scenario based stuff. Now it should clearly identify, or I should clear, because it's not a scenario based, it's a closed formula based quantitative methodology. It should clearly specify which of the risks are being covered as a part of this formula, so that informed decision making can be done and comparison with the others can quite comfortably be done, which can play a very important role in assessing the overall capital adequacy. So these are some of the important things with regards to the risk identification that every bank holding company should typically follow. Then comes different kinds of good practices associated with the internal controls. We have already said, as a part of the 7 principles, the internal controls should be very robust. There should be a good mechanism with respect to audit, with respect to monitoring, with respect to validation, with respect to verification, with respect to reviews. So there are so many important things that go as a part of the internal control. So what we are simply talking of is, what are the practices associated, or what are the supervisory practices that are recommended with respect to the internal control. First of all, if internal control practices are good, all these come under the internal control practices. If they are good, obviously the capital planning process will become more and more effective. So the processes and the practices are the one that drive the effectiveness of the capital planning process. So what are the things that are required? How good is the review? How comprehensive is the review? What is the frequency of the review? Right? And is it done by an internal audit or an external audit or any kind of third parties at regular intervals of time? So that is the one differentiator. Similarly, what are all getting reviewed? Is every model that we are developed being reviewed? And if it is reviewed, what are the checklists and the guidelines for the review? Who is performing the review? Internal, external, independent? And what are the various kinds of validation practices that are there? What are the kinds of rules or policies and practices associated with the documentation? Right? What are the procedures regarding the documentation? Is it more comprehensive? How are the changes really identified and controlled? All these things really drive the effectiveness of the process. So, from a BHC's perspective, it should be able to address the entire capital planning process. The governance rules or probably the control practices should really address all the elements of the capital planning process. So there should be policies and procedures regarding the risk measurement. So there should be policies, procedures, verification, validation, driving the risk management systems, which are used to produce input data, which are validating the models, and any other techniques that are using for loss estimate, revenue estimate. There should be a thorough validation and verification of all the models that are being used. And when any BHC is following all these things, it really helps them to assure that all the aspects of capital planning process, they are one in line with the business model of the BHC, and they are functioning as intended by the supervisory authorities, and they are really in line with efficient and robust estimation of the capital requirements of the BHC. So a more special mention in this comes for the independent review of the model and performing effective validations of the same. So these aspects should be very much in line with the supervisory guidance. So the guidelines associated with the model risk management. So whatever the review process that we are doing, there should be a policy and procedure in place, a guidelines in place, and the real review should be in accordance with these kind of guidelines. Now, who should perform this validation? Right? They should be independent. Okay. They are not the ones who have developed the model. So they should be independent. But at the same time, they should have the technical competence. And they should have some amount of power in the organization. They can't be junior level people. Someone who understands the system well. Someone who can really command the system. Someone who can really exercise some kind of influence in the organization. Right? They can't be model developers. They can't be the people from the business. So probably from a separate team of auditors who are not a part of the daily development of the model, so that they play a very unbiased role in terms of evaluating the model. Right? They can provide critical comments on the model that they are evaluating. But otherwise, it comes more and more of a biased opinion. So there should be enough care that has to be taken that the personnel who are being selected for doing this job, they should be competent. They should be more and more independent. Now, conceptually, there should be a clear-cut understanding regarding the entire verification and validation process. And on regular basis, there should be a monitoring. which includes the verification of the processes, the benchmarking, outcome analysis has to be performed at regular intervals of time, and any kind of deviation, there should be an action plan in place. And all the models that have been developed, there should be a repository of all of them, and all this repository needs to be constantly reviewed at regular intervals of time to check for the correctness of each of the models, the validity of each of the models in the current scenario. Now, apart from current scenario, there should be a thorough testing and validation of the model under the stressed scenarios as well. Right? Because generally when I design the model, I take into consideration the normal and regular business activities, and the model may work perfectly well for those business activities. But under the stressed conditions, the model may not be valid. So there should be a very thorough testing, creating different kinds of stressed scenarios and validating the model. And I have to really ensure, as a model reviewer, the validation covers all kinds of models, right? All the assumptions. I try to cover as many assumptions as possible for the creation of the capital planning purpose. So I have to think through different kinds of scenarios, assumptions, and come out with the capital planning process. So the model risk. Identify that model risk is a very critical element. So try to give a high priority to the model risk. Come out with the procedures for managing the model risk. Come out with mechanisms to strengthen the practices around the model review and validation. So a good bank holding company really comes out with a stringent process and procedure associated with model risk management. It has a strong practices with respect to model review, validation. All these form a part of the routine activity for a successful bank holding company. Then, the other important aspect, as we have looked at as a part of the sound practices, is the corporate governance related stuff. So, how often is the bank management involved in the process? What is the kind of periodic review that happens with respect to the infrastructure? So, is the infrastructure more up to date? Right? The risk infrastructure of the bank, is it more and more outdated or is it more up to date? There should be a review for that. So whatever the estimation regarding the loss, capital resources, whatever are the methodologies, are they suitable even to the today's business scenarios? Whatever the methodologies that we have in place for estimating the losses, estimating the resources, are they suitable to the current business environment? What are the capital goals of the company? Are we still in line with them? How did we set our target? Is our targets and goals aligned with the business model? What are the kind of stress scenarios that we have designed? Are they sufficient for considering the capital? Did we consider all the worst case possibilities? Are there any kind of limitations in our model? Did we list out all the limitations, processes? And so is our capital planning process more and more robust? What is the level of uncertainty that is existing around loss estimates and the capital resource estimates that we have made? All these things need to be ensured as a part of good capital governance process, corporate governance process. So that's one aspect. Make sure that the board and the senior management, they have to ensure that all these things are properly in place. But a bit more than that, you establish as a corporate, as a senior manager in the company, or as a board, as a member of the board, it's an important role to establish a comprehensive capital planning process which fits into the broader risk management process. and it has to be that capital planning process has to be in line with the risk appetite of the company, and along with that the growth, the business goals, the strategic direction of the company. So that is the role of the capital governance practice or a senior management in the organization. They have to ensure that this is in place. And when is it more and more efficient? The board of directors of the company, they take the responsibility, the ultimate responsibility and accountability for planning capital. They should be in a position, they should be competent enough to take informed decisions regarding the capital adequacy. So for that, what is that they require? They require sufficient information. So again, it can't be out of date information. So at regular intervals, they should receive the information. So what we suggest is, what the supervisory suggests is, at least on a quarterly basis, they should receive sufficient information about the different kinds of risks associated with the BHC, right? The latest, because at every point in time, the frequency of the risk, the severity of the risk keeps changing, and the total exposure that is at risk keeps changing. So the latest numbers associated with them have to be received at regular intervals of time, so that they can really make their decisions and planning very effectively. And as a part of the information, what is the kind of information they have to receive? All the limitations associated with different kinds of models, all the assumptions that are being made for different kinds of models and practices, what are the different uncertainties that are surrounding the loss estimates and revenue estimates within the capital planning process, so that any kind of a weakness in the process, any kind of challenge that is coming as a part of the process or a model, they take that into consideration for making their capital decision. So corporate governance practices, the more and more effective they are, the more will be the effectiveness of the capital planning process within the organization. Then, more specific into the capital policy practice. Now, when we are setting a capital policy, we are going right from the capital goals. How much capital is required? So regarding that, what are the qualitative guidelines as well as quantitative guidelines? How much dividend we need to pay? What is the extent of stock repurchase or buyback that can be done? Do we have proper processes and strategies in place in case the capital shortfall occurs? Internal governance procedures. What is the level of internal corporate governance procedures that are in place regarding the capital policy? What are the guidelines that are driving? All these things form a part of the capital policy practices. And what the supervisory simply says is, all these things should be comprehensively written, and they should address almost all the major components of the capital planning process of the BHC. And they can't be isolated. They have to be very strongly linked with the business model. They have to be strongly linked with all the other business growth related policies of the company. And across the layers, whosoever is involved in the capital planning process, capital policy process, I need to address the roles and responsibilities of the decision makers. So there should be clear processes, data controls, validation standards. They all needs to be properly documented and strictly adhered to. And targets should be very clearly in place. One, for the level of capital, how much of capital is required, and what is the breakup of that capital. So there should be a clear-cut target for each source of capital based on the objectives, the business model, so that it can be properly managed. Now, at different points in time as a part of the assessment, the management computes different kinds of ratios that they have to adhere to. Probably they compute a profitability ratios, they look at leverage ratios, right? They look at capital adequacy ratios. Different kinds of ratios can be used as a benchmark for regular monitoring of the situation of the capital adequacy. Now, what the process is saying is there should be a very clear-cut understanding regarding how the management has concluded that whatever the different ratios that are computed, whatever the numbers that are driving each of these ratios, they are more and more appropriate to the current business model. They are sustainable, right? How does the management ensure that this ratio is not a one-time affair? It's something that can be sustained. So it is in line with the capital objectives of the company, in line with the business model, in line with the capital plan of the company. So there should be a very clear-cut explanation from the board and the senior management in terms of why they really believe that this number is more and more appropriate. And there should be very clear-cut processes in place on how the dividend, on what basis the dividends are declared, and if at all they are doing any kind of buybacks, so on what basis the share buyback is typically being done, what is the typical process and model that is being followed by the company with respect to how it is planning to distribute the cash flows in the form of dividends or share repurchases. So there should be a proper dividend policy in place. Okay. Then along with that, there should be a very clear-cut process which talks about how frequently the capital policy is reviewed. Right? Is it quarterly? Is it every month? Is it 6 monthly? How frequently is the capital policy reviewed? And or is it only time-based, or any other triggers also that can force the company to review and reevaluate the capital policy? Because at the same time, every trigger that we are trying to look at, it has to be more and more relevant, more and more current. So there should be a proper process in place regarding the capital policy practices as well. Now, coming to the goals and targets, obvious that they have to be very much aligned with the risk appetite of the company. How much risk the company is willing to take. What is the risk profile of the company? What are the expectations of the internal stakeholders, probably the employees, the management, etc. The external stakeholders, creditors, shareholders, etc. So based on their expectations, we are setting the risk appetite and the risk profile of the company and see whether the capital goals are more in line with these kinds of expectations. So the goal should clearly reflect the current and the future capital requirement. So the current requirement as well as the future. Again, the future has to come purely from the loss estimation procedures, capital estimation procedures, capital resource estimation procedures. So if they are in place, probably the capital goals are coming as an offshoot of them. So they have to come out with these kind of requirements. Again, different kinds of expectations from shareholders, rating agencies, creditors, supervisors, everyone. So the goals and targets that are being set, they have to be in line with the expectations of different kinds of stakeholders. And based on the goal, the target has to be established. And of course, target should be slightly more than the goal so that the capital level will not fall below the goal even during hard times. So the target should be slightly higher than the goal to make sure that the levels of the capital are not falling below the goals even during the period of stress. And whatever the goals and targets the company is setting, it has to be very clearly specified as a part of the capital policy. They have to be reviewed at regular intervals of time, and that has to be approved by the board also. And these numbers, they can't be universal for all the periods. Again, they have to be based on the general economic conditions, macroeconomic environment, based on the plans of the company, right? The business model, the growth plan, the on and off balance sheet activities that are there, the risks that are coming, probably because of acquisition. The entire business environment needs to be evaluated while setting the capital goal and the target. Similarly, any external conditions, right? The macroeconomic environments, the industry environment, so different kinds of external conditions, both in the normal scenario as well as the stressed scenarios, need to be evaluated. And all those factors, what is the kind of impact they have on the capital adequacy, they have to be evaluated while setting the goals and the targets. So based on all these, the company should calculate and use different kinds of capital measures, which will be a reflection of both the leverage as well as the risk. So different economic scenarios, different conditions, what could be the different kinds of capital requirements that are there. So the targets and the goals need to be in line with various aspects, both of within the company and outside the company. Along with that, the company should also develop a very comprehensive capital contingency plan. If at all the worst situation is coming up, do I have a backup? So it's more about a remedy. If at all there is any kind of a deficiency, either now or in the future, if at all some kind of a deficiency comes up, if at all some kind of emergency comes up as a part of the capital plan, or the capital position gets affected, what is the kind of remedy, or what is the kind of backup the company has to address that kind of a situation? So there should be a detailed explanation of the circumstances where, if possible, can the company first of all reduce the dividend? Can the company put the stock repurchase kind of stuff on halt or hold? So can it reduce? Can it suspend any of these things? Under what conditions it can do that? And that too in normal conditions versus in stressed conditions. All these things, they have to be adequately documented. And at the same time, there should be a lot of flexibility so that different kinds of situations can be worked out. It should be more and more realistic as to what can be achieved during the period of stress. So the capital goals, targets, contingency planning, they all will ensure the adequacy of the capital policy practices of the company. Then, coming to the next aspect, regarding the stress testing, what are the things that we are expecting from a bank holding company? First of all, the stressed scenario needs to be created. So every BHC needs to develop a stressed scenario which is more and more appropriate in line with the business model and the portfolios of the BHC. So one, per enterprise level, there should be different kinds of scenarios, and regarding that there should be a proper process and policy in place, which again should be more and more a reflection of the business activities of the BHC and whatever are the potential threats that the BHC is visualizing, right? So again, now whether it wants to develop an internal model, whether it wants to leverage its internal expertise to typically generate a stress scenario, or use an external model, use vendor defined external scenarios, or even vendor models itself to define a customized macroeconomic scenario. So now different kinds of BHCs can use different such kind of practices. But whatever it is, what scenarios need to be used under the stress conditions? The process for selecting a specific scenario, that process should really, or the set of scenarios that need to be included, that needs to be created by taking different internal stakeholders, right? We have a company might be having a lot of risk experts, managers from various lines of business, senior management, board. There are different kinds of experts that there and internal stakeholders of the company. So all of them should brainstorm in terms of what are the different kinds of stress scenarios that need to be created. So they all need to agree upon a scenario selection process. But they have to make sure that whatever the scenarios that they are selecting, they are a reflection of the macroeconomic and the financial conditions, both of the company as well as the industry, and that has to be very much customized to the different kinds of threats and vulnerabilities that are associated with that particular BHC and a lot of idiosyncratic risks. So based on that, different kinds of stress scenarios need to be designed, and using those stress scenarios, you have to ensure that the testing is happening at regular intervals of time. Then, coming to the procedure for estimating losses, revenues and expenses. Right, we have already said that they are to be in line with the goals of the company. So there should be clear-cut procedures as a part of the capital plan of the BHC. How the revenues are going to be estimated, how the expenses are going to be estimated, how the losses, how do you compute the reserves, right? What are the pro forma capital levels? What are the minimum regulatory capital ratios that we are going to maintain? What is the tier 1 common ratio, capital ratio that is going to be maintained? Any kind of capital measures, how are we estimating all these things over the planned horizon? So for what time period all these getting estimated? So 1, under the normal conditions, 2, under the stressed condition. There should be a very clear-cut explanation of all these kinds of estimates, processes driving these kind of estimates under both normal conditions as well as the stressed conditions. And the methodologies associated with the stress testing, they have to be performed, but all the methodologies, they should really generate credible and plausible estimates. The scenarios which are not plausible, they don't need to be present as a part of the methodology at all. So the estimate should be more and more consistent with the assumed conditions in the scenario. And every estimate that is being generated for any of these items, it should be tested empirically. So some kind of a back testing kind of stuff should be performed on all those estimates. There should be an empirical evidence for that. And the whole process of estimation should be transparent and repeatable. That brings the effectiveness of the estimate. Now, it can use a good amount of quantitative approaches, so it could use the different kinds of distributions for estimating different kinds of numbers. Like for losses, it can use one different distribution, revenues, it can use another distribution. So depending on the type of the portfolio, depending on the type of the data, it can use an appropriate distribution, and it can look at it at an aggregate level or at a granular level. It can do the estimate for a short term or long term or both of them, depending on the kind of time series data that is available. And they can be done separately for each activity or for a portfolio as well. Now, different kinds of quantitative methodologies can very well be applied for estimating all these aspects. Now, quantitative approaches are very important when we are establishing enterprise-wise scenario analysis. But at the same time, if they are really deviating from the distribution, if the actual data is not following any specific distribution, then it is like it's a poorly performed, poorly specified kind of a model. Just because I have to use a quantitative model, if even if the distribution is more and more not fitting to the data, I cannot forcibly fit a distribution and specify the model. So I have to be really cautious from that dimension. So along with the usage of a quantitative model, I may even rely on the qualitative aspects surrounding it. Now, quickly looking at different kinds of loss estimation methodologies, or what are the procedures regarding the loss estimation methodologies. The internal stress testing procedures need to be designed so that all the risks that are inherent in the exposures of the BHC and in the different business activities of the BHC, they are all adequately captured as a part of the stress testing procedure. So enough time, robust mechanism, robust evaluation of the same needs to be performed. So for every kind of model that is designed or verification procedure that is designed, I have to really test out whether there is a solid theoretical basis. Did I take into consideration all the macroeconomic variables? Did I take into consideration all the other explanatory variables when I am trying to compute or estimate a loss, estimate a revenue, whatever it is? And then once I have established a model, I have to really demonstrate that a strong relationship exists between those various variables and the losses. So the process that the BHC has designed for estimation of all these things, one, it should be a repeatable process, especially when they transform the model estimates to combine the risk measures. And now, what is it typically followed? Especially all those BHCs which are having good policies and procedures in place, they use automation for all these activities. And as a part of that tool, technology that they are using, there is a clear audit trail also which clearly says right from step 1, right from the source data till the loss estimation and aggregation, there is a clear set of activities and steps which go into the calculation, and they are all clearly documented. And so they take care of the dynamic changes in the portfolio, any kind of modifications done, any modifications to the risk characteristic of the portfolio. They make sure that all the appropriate adjustments to the data, estimates, everything is documented, and they know the limitations of the model and everything. So they know right from the start till the estimation and aggregation of the losses. Now that the loss and the resource estimations are done, I need to assess the impact on the capital adequacy. So what should be the supervisory guidelines associated with assessing the capital adequacy impact? Again, there should be a documented process. So every projection that is being done, both for on-balance sheet positions as well as off-balance sheet positions, over the entire horizon. So there should be a clear-cut process for how the estimates are generated, how the projections are generated, both for on-balance sheet and off-balance sheet activities, as well as the risk-weighted assets, because risk-weighted assets play an important role in computing the capital requirement. So the balance projections, they are very key input to the enterprise-wide scenario analysis, because they play a very important role, one in the estimation of the losses and also to determine the risk weighted assets. So every company which is having good practices in place, they look at all the drivers that impact the assets, all the drivers that impact the funding balances, any kind of prepayments that are existing, any kind of non-performing assets, they are all looked at one separately in isolation, and along with that they also look at the correlation that is existing between each of these things. So they are looked at on an integrated basis rather than simply projecting the targeted balances directly, because in that case there would be a very high projection. Each element, one, it is assessed for consistency with the scenario condition and other assumption. Now, from the BHC's standpoint, the correlation, the relationship among the different aspects, revenues, expense, on balance sheet, off balance sheet, that all needs to be very clearly specified. Otherwise, it looks at very high overestimation of the number. And one important point to consider here is the BHC should not rely on favorable assumptions. One, if they can't be tested, if they can't be assured in stress scenarios, and if it is more favorable now, it should not rely on those kind of scenarios because there is a high level of uncertainty around the different market conditions. And all the risk weighted asset projections, they should be very much linked with the projections that they are doing on balance sheet, off balance sheet exposures, the risk attributes. They should be very much consistent with the severity of the stress conditions under each of the scenario. So the process to be in place for assessing the impact on capital adequacy needs to be very much enforced by the organization. So these are the different important aspects that every bank holding company needs to take care of for ensuring that its capital planning process is fully intact and is very effective for determining the adequate capital requirements. All right. So thanks a lot for listening to this session. Thank you very much.